And then for commodities or for gold, it's 94%. I know that's really important for your client base as well. And then for crypto, which I would argue is a commodity, it's a digital commodity instead of a physical commodity. The upside capture ratio there is 108% and 136%. So Dr. Mo is incredibly good at making sure that you are there to participate in the bull markets for these assets, and not there when the bull markets are not there. And so that obviously increases your risk-adjusted returns as well, because you're not wearing the returns, during these high volatility drawdowns.
Hello and welcome to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffmann. I'm the @JR Mining guy over on X, and of course, your host of this channel. And I'm looking forward to bringing back Darius Dale. He's the founder and CEO over at 42 Macro, and he's Mr. Positive in my opinion. Like, he's somebody, like when we had him on back in October 2023, who was super excited. It was positive about the markets. Things are trending up. The economy's doing well. We're seeing wage growth. Don't worry about it. Don't worry about the headlines. And I have to say, he was right. We talked about the time when the S&P 500 was around 4,100 points. We're now at 6,000 points. We're actually almost higher than that. So we're almost 50% higher. So I think there was some truth to what he was saying. And we're going to get a temperature check from him now. Like, see where the markets are at. How well is the economy doing? I just listened to the Senate Banking Committee meeting here, or testimony of Jerome Powell as well. So interesting tidbits, like what the perception is out there of the economy and what is going on. And I'm curious if that is mirrored by our guest today. Before I switch over to Darius, hit that like and subscribe button. Helps us out tremendously. It's a free way to support this channel. It means a lot to us, and we thank you for that. Now, Darius, it is great to have you back on the program. It's good to see you. Thank you so much.
It's wonderful to be here, man. I really appreciate that super kind introduction, man. I thank you so much for that.
Well, you got to give credit where credit is due, right? So we always come from the negative side. We're always looking for markets to turn around. And, coming from the gold side, of course, we're always doom and gloom looking for crash scenarios. But we keep forgetting sometimes that there can be money made, that you can make money the other direction as well, right? So, and today's like, let's reassess that market again together. Let's get a temperature check from you, Darius, and maybe to kick us off and kick the conversation off, Darius. Like, what's your current assessment of the economy and the financial markets?
Well, I'd say we're still pretty bullish. Certainly cautiously optimistic. If you go back to where we were in the fall of 2023, we were making the claim back then that, this is as bullish as I've ever been. When you combined our quantitative risk management signals as well as our fundamental research outlook, essentially coalescing on the fact that there's unlikely to be a recession over a medium-term time horizon. We had to get a lot of investors out of the hard landing camp and associated positioning into our soft landing and or no landing camp. And in our opinion, we think that catalyzed, significant performance in risk assets, since then. And so, again, appreciate the really warm introduction, because, the truth is the truth. In terms of where we are today, a lot of those positive economic dynamics are persistent, but they're not getting better at the margins. They're now starting to get worse at the margins. So that's a little bit less of a positive dynamic when we think about forward performance of asset markets from here. But again, when we look at our core risk management signals, generally still quite bullish. I don't expect them to remain bullish throughout the course of the year. When we think about our fundamental outlook, we have some catalysts developing, if you will. Many of them are likely to kind of coincide around mid-year that could potentially cause a significant correction or crash. But up until then, we could continue to see markets generally, trend higher, if not grind higher, as a function of some of that a function of the persistency of the resilience of the economy. So we can kind of unpack any of that. Actually, before we do unpack any of that, I do think it's always a good point to start with our fundamental research summary. This is kind of where we've been from a thematic perspective, and some of these themes, kind of when we formulate fundamental research themes, I think it's important for your audience to understand this. When we come up with a fundamental research theme, it's really just a function of where are we on the cycles that matter: growth, inflation, monetary policy, fiscal policy, and liquidity. Those are the 5 cycles that matter most to asset markets. And if we can identify where we are on those cycles, and more importantly, project with some reasonable accuracy, reasonable degree of confidence where we might be over a medium-term time horizon, then we'll have enough conviction to create a theme. So the first theme, these themes are organized when we introduce them to our clients. So we introduced our sticky inflation theme back in January 2022. The key takeaway from that theme is that we don't think inflation is going back to durability to 2% without a recession. And so at some point, we're going to hit the bottom of the inflation sine curve and start to cycle higher here in 2025. Our resilient U.S. economy theme, we authored that in September of 2022, back in the summer of 2022. And the real key takeaway from that theme is that the economy is resilient. There's a lot of factors that are supporting the resiliency of the economy that remain persistent even to this day, 2.5 years later. And until those factors dissipate, we're probably going to have an economy that is a ways away or well off of a recession for the foreseeable future. The third thing that we have that is still active is our Jay wants a soft landing theme. We authored that at the beginning of November of 2023. It's essentially a lot of what the Senate Finance Committee is grilling Jay Powell about now, which is, look, man, you accomplished a soft landing. And our view on that was that, he was going to implement policy. The Fed were going to implement policies that were consistent with trying to achieve a soft landing. We've seen a decent amount of that since then, and that remains ongoing, albeit to a much lesser degree than we had seen prior to the December 18th pivot. And then finally, the most new theme, the theme that may have the potential to cause the most problems here outside of our sticky inflation theme, is our triple S's theme. And the key takeaway from our triple S's theme is that when you think about the President Trump's economic agenda, there are 5 things that are sort of pretty front and center that they want to have accomplished. And 2 of them are negative and 3 of them are positive. And the size, sequence, and scope of the negative relative to the positive could potentially cause problems in asset markets. So you think about the things that they want that are negative for the economy and asset markets, that's tariffs and securing the border, which both represent negative supply shocks to the economy. The things that they want that are positive at the margins, tax cuts, deregulation, accelerated energy production, those things represent positive supply shocks to the economy. And so ultimately the net result of all those policies are either going to give you stagflation as a net result, or we're going to get something that looks like Goldilocks. Our general take is that it'll probably be Goldilocks, but the path to getting there from an asset market performance perspective could be right with some volatility, just as a function of the sequence of it all. So we'll see.
I'm just taking notes still here, Darius, just to make sure that we cover all the points, and in particular dive into some of those topics into a bit more detail. Why don't we go through it top to bottom here? Let's talk inflation, Darius. You mentioned the 2% inflation target seems unreachable right now. We're sitting at 2.9%. The trend is reversed again. Inflation is ticking up higher. Curious, what your thoughts are on the inflation thematic. Like, why is it ticking higher? Maybe we can discuss some of the fundamental reasons. Also, what is your outlook? You touched on tariffs. Curious what your thoughts are there. How are they factored in here, and what other factors are pulling on the inflation number right now?
Yeah, absolutely. So I'll start by saying that we performed a big deep dive empirical study in the business cycle, trying to identify which indicators were leading indicators, lagging indicators, so that we could better focus our daily research process on the indicators that actually matter, that are predictive. And we learned a lot from that empirical deep dive study, of which we analyzed all 12 of the post-war U.S. business cycles, not in analog format, which is how most people analyze data, but we actually decided to look at it in terms of in terms of stacking the business cycles on top of each other to identify what the median path that each of these indicators takes, late in the business cycle, early in the business cycle, et cetera. And when it comes to being late in the business cycle, and I think we can all agree that we're somewhat, I wouldn't say at the end of the business cycle, but certainly later than earlier, just judging by the level of the unemployment rate and other economic statistics, the valuations of the equity and credit market, et cetera. When you look at how the business cycles historically worked, there's this real cadence to it. And one of the key takeaways from that, understanding that cadence, is that inflation is the most lagging indicator of the business cycle. It is historically broken down on a median basis 12 to 15 months after a recession has started, 0 being the start of a recession in this analysis. And again, each of those plots in that chart on the left represents the median path that particular indicator takes late in the business cycle, early into a recession, and on the other side of a recession. And so what we know is that even from performing that analysis, we know that there's never has not been an outcome in the U.S. economy where inflation broke down durably below its trend prior to a recession. And so us having the view and really having authored the view going back to the summer of 2022, when everyone was concerned about a U.S. recession, we authored the view that there was not going to be a recession anytime soon, and that the U.S. economy was resilient for a variety of reasons. That view still persists. And so if you kind of layer that view on with our outlook for inflation, if we don't have a recession over a medium-term time horizon as a high probability event, we should not expect a durable breakdown below trend in inflation, which is what's required to get inflation back to 2% on a long run mean basis. And so if you understand this, then we understand that what's most likely to happen at some point in the U.S. economy is that we are going to wind up with inflation that hits the bottom of its sine curve and actually starts to cycle higher again, which is exactly what our model is forecasting here going into 2025. We have core PCE inflation bottoming at 1%, or so not bottoming at 1%, bottoming in Q1 rather. My apologies, bottoming in Q1 and then starting to meander higher from there throughout the course of the year. Now we're not going to have a significant acceleration projected, but it is a meaningful and durable uptrend in inflation that is very counter to what consensus is expecting, which is a persistent downtrend in inflation. In our opinion, if we're right, if the blue line is correct, which are our projections, then there's some upside risk to bond yields and downside risk to equity valuations and credit valuations as a function of that over the medium term.
Yeah, we'll talk to bond yields and the bond market in a minute as well, because it's quite interesting, like how the development of the 10-year or the 10-year yield has been over the last just couple of months actually, how it's been reacting to issues and to thematics that coming out of the White House, right? So we'll talk about the bond market here in a second. But you mentioned earlier that the economy is showing signs of still showing signs of resiliencies, and you mentioned factors. You only said factors, and you didn't really explain what those factors are. When you look, I want to break that down a little bit. When you say that the economy is resilient, what are you looking at, and what factors are actually resilient? And then maybe part B of the question we'll get to. Maybe I'll ask it separately again. Is like there are clouds starting to form on the horizon that you see coming up, and we'll get to those maybe as part B of the question. But for now, like, what factors are showing some resiliency here?
Yeah, well, the economy at large is showing resiliency. We continue to see consumer spending tracking in an above trend rate of change. I want to say in the most recent month in December, and if you look at the PCE report, PC personal consumption expenditures on a real basis were tracking north of 4% versus a pre-COVID trend of about 2.5%. So we are well north of pre-COVID trend type levels in consumer spending growth, and that makes sense because we continue to be slightly above trend on a real disposable personal income growth basis, and we're well above trend in terms of nominal disposable personal income growth. So the factors that are contributing that we identified back in the summer of 2022 that are contributing to the persistency of our resilient U.S. economy theme are fivefold. Number one, we have a historically strong household sector balance sheet. Just a key highlight from our household balance sheet analysis, one of the most important things that we identified back then that is persistent is this high level of liquidity on household sector balance sheets. Right now, we have about $9 trillion of cash on the household sector balance sheet when you combine checkable deposits and currency and money market fund exposure. That's about 5% of total household assets. You got to go back to 1950 something to get to such a high share of liquidity on the overall household sector balance sheet. That $9 trillion is up from about $3.5 trillion prior to the pandemic. So, almost a tripling, if you will, in terms of the amount of cash that's on the household sector balance sheet. So that's obviously super supportive of a continuation of our resilient economy theme. We have similar dynamics on the corporate sector balance sheet. So I would argue the household sector balance sheet, when you factor in cash and you factor in the amount of debt, the pace of debt, the terming out of debt, the debt service ratio, all the kind of factors that we look at in our balance sheet analysis, in our sectoral balance sheet analysis, those factors are about as good across the board, as good as they've ever been, with data going back to the 1940s. If you look at the corporate sector balance sheet, they're not quite as good as they've ever been, but they're close across a lot of those metrics. And one metric where it certainly is about as good as it's ever been is on the liquidity side. If you look at corporate cash, it's about $3 trillion, up from about $1.5 trillion prior to the pandemic. That's also 5% of corporate assets. And you got to go back to the mid 1950s to see such a high share of liquidity on the corporate side. And corporate debt service ratios are not quite as low as the household debt service ratio, which is at an all-time low currently still. But it's that's corporate debt service ratio is much lower than it had been, and kind of late in other business cycles that have prior to recession. So that's number two. Three of the five would be we have this income-driven business cycle where we've consistently seen income and GDP growth on a nominal basis outpace the growth of credit, and as a function of that, we continue to see a very limited exposure to the policy rate. As long as we have an income-driven business cycle, what the Fed does with the policy rate, which influences the credit cycle, has very limited influence over the broader U.S. business cycle. Another way we can kind of track that, or two metrics we can track that with, are if you look at the share of a private non-financial sector credit that's on bank balance sheet, it's somewhere around 30%. Which means the other 70% is coming from the capital markets, which obviously remain quite open and buoyant. Just pull up a chart of the S&P 500, and that'll tell you everything you need to know about capital markets. So that's number three. We have this income-driven business cycle that is reducing our exposure to the policy rate broadly, and that's something that is persistent. Number four, we have limited exposure to the manufacturing sector. And the fact that we have this limited exposure to the manufacturing sector means it lowers the probability of having a recession in the U.S. economy. Right? If you go back and you study the post-war U.S. business cycles, we have 12 to study. There have been this manufacturing sector has accounted for a median 98% of net job losses during U.S. recessions. Median. So, that just tells you that whenever we have a recession in the U.S. economy, most of the decline in employment comes from the manufacturing sector. And now that we only have 10% of GDP and 14% of employment being in manufacturing, as opposed to a high of around 25% and 50% respectively, going back to the 1940s, you just have less cyclicality in the U.S. economy. The services sector is not as cyclical. It's being driven by things like population growth and migration, as opposed to things that are much more cyclical, like interest rates and the dollar and all this other stuff. And then finally, the fifth dynamic that is persisted, that is supporting the persistency of our resilient U.S. economy theme, is what we call our West Village Montauk effect. I don't have time to write, lengthy economics textbooks, but if I did, I would go down in history as someone who just discovered this thesis, which is because we have a high stock of savings on the household sector balance sheet, we have a low flow of savings in terms of the monthly, kind of savings rate statistics. Right now, I want to say the personal savings rate declined in the most recent month to somewhere around 3.5%, which is well below the pre-COVID trend of about 6+%. And the reason we have such a low savings rate, which other investors have mistakenly, characterized as the low-income consumer being tapped out, which, by the way, I grew up very poor on the bottom 1% of the income spectrum. We are always tapped out. Newsflash, Wall Street people. We've been tapped out the whole time. So that's a faulty analysis, to say the least. But the reason the West Village Montauk effect has been so supportive for the U.S. economy is because this very large stock of savings, large stock of cash that we've identified on the household sector balance sheet, is allowing consumers to spend a greater share of their weekly or monthly income into the economy, because they don't have to save as much, because we have this gigantic stock of savings on an aggregate basis. And so the final thing I'll say is just, when you analyze the economy, you got to think about it in aggregate terms. There's been far too much analysis on the distributional effects of some of these dynamics. And the reality is the distributional stuff makes for good talking points. But if you want to get the economy and asset markets right, you got to think about things in the aggregate.
Yeah, absolutely. There are some fantastic points you made there. Absolutely. I want to follow up on a couple here, maybe just to clarify. The consumer spending, like, there always needs to be confidence that the consumer is like, when I spend, I need to be able to finance theoretically and afford it. Right? It can, even if I take out a loan, I need to be able to pay back that loan. That would be the initial, like, that's how you're supposed to do it, right? Like, you buy a car, of course you can't put up $100,000 or whatever you spend on a car, $50,000, $40,000, doesn't matter what the price is. You'll have to pay it back. That's how you should go enter it. So you got to have some confidence that you're able to pay it back. So that confidence seems to be pretty high. But I do have a couple like detailed questions, meaning like, where's that wage growth coming from? Like 5.7% is quite a bit. And I'm wondering if it's just government spending, like, is it productivity increases? Like, where is that wage growth coming from?
Yeah, well, there's been a lot of chatter around the labor market as it relates to the sectoral composition of job growth. We've obviously seen the share of jobs that are to government, that are from government employers and from non-cyclical sectors like healthcare rise in recent quarters. In my opinion, part of the reason they're rising is because we're seeing a declining share of jobs in the more cyclical manufacturing sector, not necessarily a faster pace of growth in those particular sectors. But the reality is that it's broad-based. When you look at something like the private sector employment cost index, we accelerated to, I want to say, around 3.5% in the most recent quarter in Q4 from kind of a cyclical low of about 2.9%. And so both of those statistics are, kind of well north of the kind of 2-ish% type trend level that we observed prior to the prior to the pandemic. Another, we look at our, when we study the jobs market, we pretty much only look at private sector dynamics in the jobs market, because the public sector is helpful for understanding the overall spending impulse, but it's not a meaningful share of the job market. And more importantly, I think as investors, we should care more about the private sector because it has a more direct influence on company earnings. But when we look at private sector labor income growth, which is the frequency adjusted productization of private sector employment, private sector average hourly earnings, and private sector average weekly hours, we actually accelerated to a well above trend rate of 6.6% in the most recent month. And so, I want to say that's about double what we used to track prior to COVID. So, whether it's, we can argue about the distributional impacts of these statistics until the cows come home. But the reality is it won't detract from the key takeaway, which is the labor market is incredibly resilient. Consumers are generating a tremendous amount of income growth. We are in an income-driven business cycle. So, the level of the policy rate, the fact that the Fed policy is quote unquote restrictive, which we disagree with, but the fact that they think their policy is restrictive is really not much of an influence on broader economic activity.
Yeah. Like, talking about impact on economic activity, I think the interesting part, like I wrote down as well, we got to talk about the impact of higher interest rates on the economy and the economic activity. Based on what you've been saying, and I hope I'm summarizing this correctly, is like there weren't really any effects felt. There's always lag effects anyway. Like when you put in higher rates or cut rates, it doesn't happen. You don't feel the effect tomorrow. So I'm curious, like, what do you see, like, and how do you track those impacts?
Yeah, well, one of the reasons I don't think we saw many effects is because the share of assets that the private sector owns, the ratio of private sector assets that reprice with the policy rate. So if you think about the amount of cash that we have and checkable deposits of currency and money market fund exposure, the share of that sum of assets, is roughly on par with the share of liabilities that reprice the policy rate. So one of the metrics that we created to track this sort of a dynamic, this is kind of a Warren Moser-esque dynamic, if you will, which is, okay, are we actually getting more net income from the level of policy rate than we are paying? And I would say it's getting pretty close to a 1-to-1 ratio. In fact, that ratio between those two household assets that reprice the policy rate relative to the household or to private sector liabilities that reprice the policy rate, it's almost a 1-to-1 ratio now. It's 0.94. And so, obviously there's, again, the sectoral composition is and the distributional aspects of the data can be argued, but what can't be argued is the fact that we're receiving just as much cash from paying from interest as we are paying it out at this point. And so I would argue that the level of policy rate from this starting point is kind of moot. It will matter, and it certainly has, it certainly is restrictive for certain borrowers. The more you are, the less assets you have, and the more you are tethered to the bank lending market for credit growth, which the median to lower income consumers are, and in both of those satisfy both of those categories, and small businesses satisfy both of those categories as well. The more you're in that cohort of economic agents, you're going to be feeling restrictive monetary policy. But that is offset, more than offset, by people who aren't in those categories, and businesses that aren't in those categories that are getting credit from the capital markets and have a lot of assets that are receiving interest.
I asked you earlier, like, to clarify, like, sort of the clouds that you start to see forming on the horizon here. Like, we need to talk about that. Like, where are they coming from? You mentioned like tariffs and immigration could be like negative supply shocks to the economy here. But tariffs are difficult to grasp because they're announced one day and then they're taken off the table the next. Like, how do you factor those into your model? And what are some, like, let's call them concrete indicators that you're looking at, right? Like, not just headline indicators.
Yeah, no, totally. To me, tariffs, the tariffs particularly for the U.S. economy, tariffs are a sideshow. We're a very relatively closed economy. They're very likely. We did a lot of math on this. Is just they're not big enough. Even the ones even the most draconian tariffs President Trump's proposed, are very unlikely to have a significant negative impact on U.S. economic activity. It will be negative, but it won't be as bad. It will be as bad as it would be for the rest of the world. It'd be significantly worse for the rest of the world, just given that their exports as a share of GDP is much higher. We are kind of the end source of demand for a lot of their industries, right? We're not the end source of demand for a lot of our industries. We are the end source of demand for their industries. But when it comes to tariffs, to me, the number one thing we need to be focused on as investors is not the impact that it's going to have on the U.S. economy, which is less than the impact that it will have on the global economy. To me, it's the impact that it will have on the U.S. dollar. Because ultimately, historically, what we found is that tariffs have historically been offset in the currency market by the country that gets the tariff levied upon them. We've seen this in previous tariff episodes. If you go back to 2018, 2019, China, throughout that, kind of U.S.-China trade war, devalued the Chinese yuan by, I want to say, about 12 or 13%. And the issue as it relates to the broader strength of the U.S. dollar is you typically see sympathy devaluations when a country is big and is connected from a trade flows perspective as China devalues its currency. So we saw, if you look at it on a DXY weighted basis, the kind of inverse dollar index, if you will, like the euro, the British pound, Japanese yen, et cetera, Swiss franc, Canadian dollar, those countries on a DXY weighted basis depreciated their currencies the same percentage that the China devalued the yuan in that particular U.S.-China trade war back in 2018, 2019. And the reason this is important, throwing up a slide on the screen here, when we study global liquidity through the lens of our global liquidity proxy, which is the aggregated central bank balance sheet from the 10 major economies, the 10 largest economies in the world, their their broad money supply, and their fiat FX reserves, that metric, that our 42 macro global liquidity proxy, has been very much inversely correlated to the U.S. dollar, and has been very inversely correlated to currency volatility, which tends to rise whenever you have an appreciating U.S. dollar. And so, in our opinion, if we got a significant, kind of advent of fresh tariffs, like, right now we've seen, kind of President Trump paying, kind of hot potato or double dutch with these tariff announcements. But the reality is we've been on tape for months now saying that because they're likely to use the reconciliation process here to extend and expand the Trump tax cuts, they're going to have to find revenue offsets and expenditure reduction offsets to offset the deficit impact that expanding the Trump tax cuts would have relative to the baseline of current law. And so you're talking about a situation where you could have significant dollar strength, from this point forward. Obviously, we've seen a lot priced in terms of anticipating tariffs in the currency market, but I don't think the full impact of it is yet to be felt, because we probably haven't seen, China meaningfully devalue the yuan in anticipation of or in response to tariffs yet. And as a function of that, we have not seen those sympathy devaluations that we were warning about. And so if we did see all that, at some point, we're talking about a significant reduction in global liquidity. And the reason that's a headwind for markets is because, not the reason it's a headwind for markets. We know global liquidity, a significant reduction in global liquidity would be a headwind for markets. We can just see this, right? The global liquidity is a key driver of asset markets. This chart shows black line is the year-over-year rate of change of our global liquidity proxy. Blue line in this chart is global equity market cap. The Bitcoin orange line in this chart is the Bitcoin market cap on a year-over-year rate of change basis. And as you can see, the blue line is highly correlated to the black line in the chart on the left, and the black line is highly correlated to the Bitcoin orange line in the chart on the right. So we know that if we have anything like significant dollar strength weighing on global liquidity, we're talking about a significant decline in global liquidity that may ultimately cause a significant decline in broader asset markets. And that's kind of the key risk that we see with tariffs. And in my opinion, that's something that we're going to have to deal with at some point in 2025, likely in and around mid-year.
Yeah. No, the US dollar, I think, is key in a lot of things. And the question is, like, how strong do you want the dollar to get? The second you announce a new tariff, the Dixie ticks up. So you have to be very careful, because you don't want the dollar to get too strong, because then nobody will buy your exports, right? Because they can't afford it. So it's like, the question is, like, where do you find that balance? Like, do you have an idea for us, Darius? Like, where is that fine line? Like, where is the balance? Because I think actually Trump wants a weaker dollar so you can export more and close that import-export gap here.
Yeah, in my opinion, I don't think there is a equilibrium line or a threshold line. To me, I just think it's the momentum in these time series that really matters. Eventually, you gather enough momentum to change, investor positioning, right? If liquidity declines enough over a long enough period of time, you're going to cause investor positioning to change, and that, in my opinion, is what really matters. So, if there is a magic line in the line, I'm not smart enough to determine that ex ante, but I do know that if we move for a long enough period of time in the wrong direction, some of these key metrics like global liquidity, that's when you start to see an unwind of crowded bullish positioning. And on crowded bullish positioning, Kai, I think it's important to kind of highlight our positioning model, which has been signaling some crowded bullish positioning in recent months. If you look at so how our positioning model works is we're tracking, tracking about 15 different time series, long-term time series that have, daily data going back multiple economic and market cycles. We're tracking them on a percentile basis relative to how those time series scored at these major bull market peaks or at these major bear market troughs. And how the model works is if we have enough, if we have enough signals essentially breaching major bull market peak type levels, or enough signals breaching major bear market trough type levels for those respective indicators, then we'll say, hey, we're due for a significant reversal significant reversal or significant unwind of crowded bullish or bearish positioning. And then a secondary consideration for this model is, there are indicators that move that are more volatile and tend to build and unwind faster than others. And those ones to the left there, we tend to correlate those positioning indicators with what's likely to happen over a short to medium term time horizon in asset markets. So let's say over the next 1 to 3 months. These indicators, they're more stable, they're more sticky, they're less volatile. They tend to build and build and build up until you get to a critical level that is historically consistent with major bear market peaks or troughs. And when you look at those indicators, most of them are already breaching levels that are consistent with these major bull market peaks. August 87, July 1990, July 98, March of 2000, October of 07, April of 2011, September of 2018, February 2020, and January of 2022. The AI stock allocation is already breaching its median value that has historically been observed at those major bull market peaks. The AI bond allocation has not breached to the downside, but it almost is, basically right there. The AI cash allocation survey has already breached to the downside. The median value that is observed at these major bull market peaks. We're not quite there in terms of realized volatility as a proxy for systematic fund exposure, but we're getting there. If you look at implied vol correlations as a proxy for market neutral hedge fund exposure, we're in the second percentile. So market neutral hedge funds have about as much gross market exposure as they possibly can have at this juncture. The S&P 500 valuations in the 96th percentile, also breaching the median value we've historically observed at these major bull market peaks, and then investment grade credit spreads, their third percentile, breaching the median value that we've historically observed at these major bull market peaks. So the key takeaway is that there's a lot of crowded structural bullish positioning in the market by the kind of the slower moving participants in the market. And you start to see things like anything that could potentially cause some of these key drivers of asset markets like global liquidity to decline significantly and persistently could really start to cause this crowded bullish positioning to unwind. So going back to your original question, when I think about tariffs, to me it's about how strong is the dollar going to get, how much is that going to weigh in liquidity, and how much is a decline in liquidity going to cause crowded bullish positioning to unwind. That, in my opinion, is a reasonable probability risk, kind of starting in Q2 or Q3 of this year.
Like talking about asset class that you just touched on, like we've talked about the US dollar, we touched on the bond market a little bit, but we need to talk commodities as well. How are they impacted? For example, I'm looking at the copper price right now, and since the start of the year, copper has shot up 60 cents from $4 to $4.60 a pound. Make sense of it a little bit, because especially when I'm looking at gold, we're trading at $2,900 right now an ounce, $2,905 to be exact, while the Dixie's at $108, $109, so fairly strong, and they've been going up together more or less. And I'm curious what your thoughts are there, and how are they impacting each other these days?
Yeah, 100%. So historically, commodities have been inversely correlated to the U.S. dollar. That's something we can very clearly observe in statistical analysis. However, they're not always inversely correlated to the U.S. dollar. And so, in my opinion, I think what we've seen certainly in this sort of post-COVID area or period is we've seen supply dynamics really have a significant influence on commodity markets, say like crude oil. I've seen demand dynamics have a significant influence over commodity markets, say like for copper and the AI trade, et cetera. And so I think one of the things we have to do as investors is first and foremost figure out what's driving a particular commodity market or a segment of the commodity market. Like, what is is it supply or demand right now? And it is not always static, as Kai. Sometimes the market really cares about supply dynamics because there's some significant variance anticipated there, or the market really cares about dynamics because there's some significant stimulus or something or contraction anticipated there. When it comes to each of these individual commodities, we tend to think about commodities we think about every asset class as a momentum asset class. By the way, our entire risk management process is designed to identify inflections in broad market momentum, and then using the inflections in momentum at the factor level to actually generate investment recommendations at the asset allocation and portfolio construction level. And so looking at our latest refresh of our Dr. Mo model here on slide 14, we see that Dr. Mo is currently recommending a long max position in ag right now. And part of the reason for that is we're in a risk-on reflation market regime in which ag has historically performed well, and ag itself has bullish from the perspective of our volatility adjusted momentum signal. So its own individual bullish momentum condition is properly coinciding with the current market regime in which you should be long ag to begin with. And so right now, Dr. Mo is suggesting you should be long a max position in ag commodities. It's suggesting you should be long a half position in base metals and industrial commodities because those are only neutral from the perspective of their own individual VAM signal, even though you generally will want to be long those things in a reflation market regime. Broad commodity exposure, they actually broke out today to a long max position. They were neutral, so they were a long half position, but today they broke out to a long max position, so investors should be aware of that. And then what else on the commodity side? Crude oil. Crude oil is currently a long half position, but I got to imagine that they're probably on the precipice of breaking out to a bullish bias there. So I think there's so much going on in the commodity market. I don't want to pretend like I have all the answers on the supply and demand fundamental side, but I think even trying to stay abreast of the supply demand fundamentals for all the individual 19 components in the CRB index, to me that's a full-time job that most people are probably going to do poorly. So in my opinion, I think you would do well to rely on more quantitatively oriented signals like this. And we know Dr. Mo works, right? You look at our back tests on commodities, if 237% of the cumulative performance of the CRB index since January 1998 has, it's come when Dr. Mo is telling our clients to be long commodities. So, for example, if you would have made, let's say the CRB index was up, 100 percentage points from January 1998 to now, obviously that's wrong, but just use it as a stylized example, you would have made 237% just being long commodities, the CRB index, whenever Dr. Mo was telling you to be long it. That upside capture ratio is about 157%. And then for the commodities or for gold, it's 94%. I know that's really important for your client base as well. And then for crypto, which I would argue is a commodity, it's a digital commodity instead of a physical commodity, the upside capture ratio there is 108% and 136%. So Dr. Mo is incredibly good at making sure that you are there to participate in the bull markets for these assets, and not there when the bull markets are not there. And so that obviously increases your risk-adjusted returns as well because you're not wearing the returns, during these high volatility drawdowns.
If you were to go back to the commodity slide that you showed us, that you circled a few things, because you didn't touch on gold, and I just quickly want to follow up on not this one.
Oh, Dr. Mo.
The overview here. That one. There you go. Because you didn't touch on gold, and it says long max position. Can you explain to me what that means, and why is the RSI in red?
Yeah, well, the RSIs in red is gold's wickedly overbought. So in this table, it just flags RSIs that are above 75 on the overbought side and below 30 on the over. Below 25 on the oversold side. And so it's just really trying to help clients identify. Okay, even though Dr. Mo suggests this is you want to have a long max position. If you're brand new to 42 macro today and you've never seen the fact that we've had a long max position in gold for the better part of a year and a half now, that you would have, this may not be the best day to go long max position. Maybe you want to leg into that. So that's what the RSI indication, that's what the RSI signals is for. But the broad key takeaway is that, if you're long these assets when you're supposed to be long these assets, an emphasis on the word when you're supposed to be long these assets, you can maximize your returns in these asset classes without having to ever truly understand supply and demand dynamics to the same degree that the folks who are, a lot of the folks who are operating in these markets understand the supply and demand dynamics. I think it's important to understand the supply and demand dynamics because they help you decide, okay, do I want to be long ag, base metals, commodities, crude oil, or gold? How do you determine between those particular factors? But the real key takeaway is that the broad risk management signal of when to be long and when not to be long is a much more thoughtful and much more lucrative way to approach asset markets than just saying, oh, the supply and demand dynamics or the fundamentals are bullish or bearish. Because the fundamentals, again, they can help you determine which assets you like versus other assets that you may not like, but they're not going to be fundamental research. Fundamental analysis is not helpful for market timing. If your goal is to have good market timing, which we've shown is possible if you have the right signals and the right tools, good market timing increases your nominal returns, but it also increases your risk-adjusted returns, and that's what we do. That's why what we do here at 42 Macro.
No, fantastic, Darius. Really appreciate you clarifying that. And maybe I want to come back to one last, maybe theoretical question. We briefly touched on it, but we haven't covered the topic yet. It's really like the role of Jerome Powell and the Fed, and whether they've actually done a good job managing whatever it is actually that we're steering through right now. It's really difficult to even put a finger on it. I don't want to do Jerome Powell's job, quite honestly. Just being sitting there in the chair, getting grilled twice a year by the Senate Banking Committee doesn't sound like fun at all, and doesn't look like fun at all either. But they were quite chummy, apparently. Like from what I've seen, I haven't paid full attention to it, but I've written down one thing that Mr. Senator Kennedy said. I forgot which party he's from and what state he's from, but he said, yeah, like we've experienced a soft landing, and he called it a soft landing, and he's giving Jerome Powell a lot of credit for it, and he's asking why Jerome Powell hasn't taken any credit for it. So the question is, like, on a theoretical side, A, has Jerome Powell done a good job? B, like you touched on it very early on in our conversation, like the soft landing scenarios. Like, are we in a soft landing scenario? And do you agree with the actions that Jerome Powell and the Fed have taken?
Well, again, do you agree with the actions? Depends on what is the goal. If the goal is to engineer a soft landing, then yeah, I think they've done a masterful job of trying to engineer a soft landing. Now, the reality is this soft landing is, according to what we talked about earlier in the context of our sticky inflation theme, a soft landing is going to, over the course of the next couple of quarters, in our opinion, based on our analysis, going to morph into a no landing. And that could be an issue for asset markets in the context of what's currently priced. But that's neither here nor there. But if the goal was to engineer a soft landing, then they've done a marvelous job of engineering soft landing. We got employment growth, kind of nominal income growth tracking in at above trend level. We got consumer spending growth tracking in at above trend level. We have GDP growth up until Q4 was tracking in at above trend level. And we've had inflation persistently decelerating on a trend basis since mid 2022. That's about as good as it can get. So I mean, yeah, you should take a victory lap for achieving those outcomes. Now, the problem with it is that the interpretation of what's actually happening is always changing, right? The more we going forward in time, we can more from having a soft landing to a no landing. So when I think about kind of the Fed's influence on broader asset markets and the economy, I think it's important to show a few slides here. So I'll start by saying, the Fed, they've done a great job of convincing cohorts of market participants that their policy is restrictive. And the fact that they've done a great job of that is really, in our opinion, because that was untrue, the fact that we've had businesses and investors both had to come from the hard landing camp to the no soft landing and or no landing camp is what catalyzed incremental growth in the economy, incremental growth and appreciation in broader asset markets. In fact, this is the Fed kind of burying its head in the sand. You can kind of say like, hey, this is the economy and this is asset markets. They've been broadly ignoring the fact that the economy in aggregate and asset markets in aggregate have been very much rejecting of their view that policy is restrictive. In fact, if you think about where the Fed is right now, the Fed still thinks the neutral rate is about 3% compared to a Fed funds rate of about 4.5%. And so, with a neutral rate down at 3% and the Fed funds rate at 4.5%, this is a Federal Reserve that even today thinks that its policy is still 150 basis points above neutral. And so, they've had this bias to ease. They've pushed through 100 basis points of rate cuts starting in September, despite the fact that inflation was above target, well above target in many cases. And so in our opinion, we think that, it was indicative of the asymmetrically dovish reaction function that we identified at the beginning of November of 2023. We said, hey, it looks like they're going to have an asymmetric response to incoming growth and inflation data. If the labor market deteriorates at all, they're going to be cutting and easing. But if inflation does not stop, if inflation stops going down, they're probably not going to be hiking. And identifying that condition, allowed us to generate that theme, which was part parcel to one of the reasons why our clients did such a good job of taking advantage of the raging bull markets we've seen since then, going back to the fall of 2023. And then the final thing I'll say on with respect to the Fed's policy, you look at the Fed's policy. This chart here shows the Fed funds rate. The top panel shows the Fed funds rate minus the baseline Taylor estimate. So that's the spread area chart there. We never got in this particular business cycle, in this tightening cycle, to a positive value, which means, according to the Taylor rule, the Fed never got the policy rate to a restrictive setting. Now, that's pretty remarkable in the context of them having already cut 100 basis points from the peak rate, and more importantly, cutting with core PCE inflation, 50 to 100 plus basis points above their 2% target. So, if I showed you one chart or one panel from one chart to tell you everything you need to know about the Fed, it's probably this, is that these guys are unwilling to do what it takes to get inflation durably back to 2%, which is, in our opinion, that goes back to what I said at the beginning of this conversation, is I'm not sure that that's what they want, right? In order to get inflation durably back to 2%, if the underlying equilibrium rate of inflation is higher than 2%, you're going to have to push the economy into recession. And I don't think Jay Powell wants a recession. I don't think members of the FOMC want a recession. And so ultimately what they're doing is kind of forcing us as consumers, businesses, and investors to accept a higher trend level of inflation, which, all things being equal, keeps the economy, operating, keeps the financial markets, valuations continuing to expand. And ultimately, it just keeps the system and the game going for longer than a lot of the bear porn purveyors are allowed to communicate.
Yeah. No, Darius, my camera just died real quick. I'll restart it, but I'll ask my question from the off here. And it's my last question to you as well, Darius. But if you were the Fed chair, March 18th, you wouldn't have to consult with any of the other Fed members. You wouldn't have to, report to an Senate committee or anything. What would Darius do? Like, if you were the Fed chair March 18th, would you hike, stay neutral, or would you cut?
Darius Dale, I've been in the view. I've since we authored our sticky inflation thing back in September or January of 2022. We've been of the view that the Fed needs to increase its inflation target, and we're not going to explain why we think the Fed needs to increase its inflation target. But increasing its inflation target will ultimately allow the economy to grow for a longer period of time. It'll allow asset markets to appreciate for a longer period of time. And, what we found through, distributional studies, like the New York Fed has done a study, Chicago Fed has done a study. I want to say the Federal Reserve Bank of San Francisco has done a study. What we found is that the longer the business cycles take, the more the gains start to accrue to the lower income parts of society, to people who've historically been disadvantaged, like, African Americans, the Latino Americans, women. You tend to see more inclusive growth the longer business cycles last. And so ultimately understanding that at least according to our model, that the equilibrium rate of core PCE inflation is now in the high 2s and low 3s. If you're trying to guide us and implement policy to get us back durably to 2%, you're ultimately going to wind up with shorter business cycles than you otherwise should have if your goal was to promote maximum employment, not just employment amongst certain people, but maximum employment and maximum wage inflation for the broader, kind of U.S. population. So let me explain this chart real quick, or this table. This table is our secular inflation model. We introduced this in January of 2022 when we authored the theme. And the key takeaway from the analysis is that the equilibrium inflation rate of core PCE inflation is in the high 2s, low 3s. And how we determine that is that we study the movement of these key indicators of core PCE inflation, at least according to our analysis and other reviewing other academic literature. And so we look at it on a delta adjusted Z-score basis relative to the prior regime. And so we effectively trying to identify, okay, how much have these indicators changed structurally, not necessarily cyclically, but like, are they just significantly, are we in a new area code as it relates to the values of these indicators? And if you look at the model on an unweighted basis, it's suggesting that the equilibrium rate of core PC inflation, which would be the horizontal line in this stylized diagram, is somewhere around 2.9%. On a weighted basis, based on our analysis of the indicators that probably have more salience in this particular business cycle, on a weighted basis, is the horizontal line there in the stylized diagram, somewhere around 3.1%. We've refreshed this model every single month since we introduced it back in January of 2022 for our clients. And on the low end, we've seen probably somewhere around 2.6, 2.7%. On the high end, we've seen somewhere around 3.2%, 3.3%. So we know even if it might not be 2.9 or 3.1, it's somewhere in the high 2s or low 3s, especially when you look at it on a weighted basis. Things like fiscal policy, if you look at the latest sovereign fiscal balance to GDP ratio of minus 6.9%, that's essentially a record non-war, non-recession budget deficit. It's contributing some positive uplift to the equilibrium rate of core PC inflation. Deglobalization. If you look at the decline in the imports and goods and services as a percent of GDP at only 14%, it's contributing some structural uplift in that equilibrium rate of core PC inflation. If you look at the shortfall in housing supply, if you look at the household formation divided by its existing home inventory ratio, the latest values 0.3 or 1.3, it's contributing a tremendous amount of inflation to the equilibrium inflation rate, core PC inflation rate. That 1.3 is basically double where it used to trend prior to the pandemic. We just have a structural shortage of housing now in the U.S. economy relative to the growth rate of household formation. If you look at productivity and technology, these are factors that are offsetting the hawkish influence that most of the changes in the economy have contributing to this equilibrium level of core PC inflation. Productivity growth is accelerated, and we're now contributing. We should be having a disinflationary impact. The proliferation of technology throughout the economy is having a significant disinflationary impact on the equilibrium level of core PC inflation. And then finally, wages are currently tracking at 3.8% on a year-over-year basis in terms of the employment cost index. That's contributing a significant amount of a hawkish influence over the equilibrium rate of core PC inflation. And then lastly, we talked about earlier the West Village Montauk effect. If you look at checkable deposits and currency as a percent of total household assets, that's about 2%. That 2% is about as high as we've ever seen, and contributing just a gargantuan amount of underlying inflation pressure in the U.S. economy. I mean, this is money that can be spent into the economy at any point in time, just based on consumer confidence. So when we net all this stuff out, again, we're talking about an equilibrium level of core PC inflation that is in the high 2s and low 3s. And if you're trying to get us back to 2, which I don't think they're trying to do, by the way, I think they already positively revised their inflation target. I mean, telling us you're not going to get back to 2% inflation until like 2027 or 2028 in 2024, in my opinion, is a very clear indication that they don't really care about 2% inflation. For anyone who's like me, who's paying attention, if you're paying attention, you know that the Fed doesn't care about 2% inflation because they're not even trying to get us there. But if they do start to try to get us there, if that is their goal, then you're talking about an economy that has to run much tighter monetary policy consistently and durably, not just in this business cycle, but in subsequent business cycles, because the underlying equilibrium level of core PC inflation is now much higher. But if you just accept the fact that it's much higher because of dynamics that the Fed has no control over for the most part, they have almost no control over most of these dynamics, just accept the fact that we have a hotter economy, then you can kind of let the economy run a little bit hotter, run a little bit looser monetary policy than you otherwise would if you had a 2% inflation target. And ultimately, you start to see the benefits of a durable business cycle really start to accrue to the people who've been kind of on the outside looking in for a long period of time.
Yeah, no, really appreciate that, Darius.
If I was the Fed chair.
Yeah. No, okay. No, I really appreciate that, Darius. Like, there's so much going on, of course, so many factors to consider. It's usually not a simple answer, of course. So I do get that. Darius, like, we do have to make a cut here. We still have a lot of topics that, we should have touched on. We haven't barely touched on the bond market, for example, right? And how that is developing. But we do have to make a cut here because I know you have a card off. I have a hard cut off as well. But Darius, super insightful. Like, where can we send our viewers? Where can they find more of your work?
Of course, man. 42macro.com can check us out. Obviously, that was only a tip of the spear in terms of the analysis and the solutions that we provide to our clients. So hopefully you guys come check us out if you want to get our views on the bond market and things like that.
Absolutely. Darius, really appreciated your time. Thank you so much. It's great to catch up with you again. We'll have to get you back on very soon again and see if those clouds are forming and whether they turn into thunderstorm clouds or whatever you want to call them. Like, I'm not an expert. I'm not a meteorologist. So meteorologist, that's the word. So Darius, thank you so much. And everybody else, thank you so much for tuning in here to Soar Financially. I hope you enjoyed this conversation with Darius Dale. I have tremendously appreciated his time and his knowledge, what he's been sharing with us and what kind of indicators he's looking at. Very data-driven approach. So like you said last time, forget about the headlines. Look at the data. And the data is telling us that the economy is resilient, we're doing okay, and that trend will continue in the foreseeable future, meaning for me the next 6 months. I don't dare looking any further ahead. It's almost impossible to make any predictions these days, actually until tomorrow. So we'll have to take that into consideration. But if you haven't done so, subscribe to our channel. We tremendously appreciate it. We have some phenomenal guests coming up in the next 30 days. We're doing a bit of a YouTube challenge. It's the first time I'm mentioning it. meaning we'll have 30 videos coming out in the next 30 days starting February 17th. So make sure to follow us for that and don't miss a single upload by even hitting that notification button. So thank you so much for tuning in. We'll be back with lots more. Thank you.